Hello. Welcome to In 180 Seconds. Today, we will learn what is a call option in trading. Option is a contract between a buyer and a seller. The contract talks about trading a stock at a predetermined price called the strike price and has an expiry date. The buyer who is interested buys it for a small fee, also called as the option premium. Let us choose Reliance as our stock. It is currently trading around Rs 2,000. There could be someone out there who might think the price of Reliance could go up by the end of the month. At the same time, someone else might also feel the stock would not go beyond a certain price, say Rs 2,100 by the end of the month. So this person writes a contract. The contract says, the current price of Reliance is Rs 2,000, but I can sell it to an interested buyer for Rs 2,100 by the end of this month. Here the end of the month is treated as the date when this contract expires. And the Rs 2,100 at which the option contract was written, is called the strike price. Okay. But in order to sell it at Rs 2,100 by end of this month, you need to pay the seller a premium of Rs 20 per share of Reliance. Also, remember the option or contract is done on a minimum lot size of a stock. This lot size varies for each stock. The lot size for Reliance is 250. So you could trade a minimum of 250 stocks or in multiples of it. So the total fee that the buyer should pay would become Rs 5,000 for one lot. So who gets the profit? The seller would be happy if the price of Reliance stays anywhere below 2,100. He will get to keep the 5,000 fee he collected from the buyer. And the buyer loses that money. Now, if the price of Reliance goes to Rs 2,500 by expiry, then the seller is obligated to sell the 250 stocks to the buyer at the agreed price of Rs 2,100, although the current market price is Rs 2,500. Which means he would end up with a loss of 2,500 minus 2,100 for each share of Reliance. Remember, the deal was done on a one lot of Reliance. So the total loss would be Rs 1 lakh. However, the premium of Rs 5,000 he received from the buyer is his money. So the effective loss is Rs 95,000. And this Rs 95,000 is the profit that the buyer gets for doing that option trade. As you could see, by the expiry date of the contract. These are some of the possible profit and loss scenarios. Take a pause and absorb it to get a better hang of it. The loss for the seller is unlimited and the maximum loss for the buyer is the premium he paid, which is Rs 5,000. One thing to note is the buyer need not hold the call option until the expiry of the contract. Between the time he bought the call option and the expiry date of the contract, the buyer could freely sell this call option in the market to someone else. Hope this is clear. So here comes the definition. A call option gives buyer the right, but not the obligation, to buy a stock at a specified price within a specific time period. A call buyer profits when the underlying stock increases in price. And the opposite of this is the put option, which we will take a look in the next video. Until then, thanks for watching. Stay safe. Goodbye.